Hello, my name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals, help them pay the least amount of taxes possible whilst keeping them out of jail. So, today I wanted to talk about the true cost of an employee and hiring employees. I have a number of clients where they are at the juncture where they may have started out small, where it's just them in the business. They might have hired a few contractors. However, they're getting to the point where they need to bring on full-time employees. I have these conversations with my clients when they're trying to budget out the cost of the employees. Usually what they'll do is they'll just take into account the salary that they're paying them. So if you bring someone on and you're paying them, say, 50,000 a year, most folks who are new to hiring think that was the only cost. And they fail to budget for the expenses in addition to the actual salary that they're paying that individual. And it is something that's crucial for an employer to understand when they're bringing people on board, actually how much the employee costs from a budgeting standpoint. You know how much that you're sinking into an employee when you bring them on board. I wanted to go through it's roughly three hidden costs that one must account for when bringing on employees. First, payroll taxes. Many folks who have been employees before know that when you collect the paycheck, you have taxes that are taken out. You have your regular income tax, but you also have Social Security tax. However, some employers don't know, at least when they're first starting out, that employer must match the Social Security taxes that are withheld from the employee's check. So if you have someone on payroll and you're paying them 50,000 a year and they have Social Security taxes withheld from that paycheck, the employer actually must match those same taxes that are withheld from the employee's check to submit. So let's say on 50K, it's roughly $6,000 that's withheld over the course of the year from that person's check. The employer actually has to kick in the same exact amount, another 6,000 to submit to the taxing authorities. So you're actually paying $12,000 to the IRS. 6,000 came out of the 50K that you paid your employee, and the other six comes out of your pocket. So that 6,000 comes a hidden expense. The good news is that a bulk of that tax is limited. On a bulk of the Social Security that you have to match, you only have to match a majority of it up to a certain limit, which goes up every year. So for Social Security tax, you're looking at 7.65% on the first roughly 150,000. And then after the 150,000, so let's say that you're paying someone $200,000 on that next 50K and beyond, you only have to pay 1.45%. So you do have to match, but the dollars drop significantly once you get over that 150K threshold. Nonetheless, it is an expense that you have to come out of pocket. And each state has its own state payroll taxes that you have to pay. That's normally in the neighborhood of probably no more than 2%. Every state is different, so that varies, but you probably have to account for at least 8 to 8.5% of the payroll that you pay your folks that you'll have to kick in additional payroll taxes. Definitely a thing that you need to account for. Point two that you need to account for is workman's comp insurance. Now, this is not in every state because some states have mandatory workman's comp coverage where you're an employer must have workman's comp coverage for all of your employees, but this is not mandatory in every state. I'm in the Northeast. Most of the states in the Northeast do require it. States like in the South, a lot of red states that don't necessarily require workman's comp insurance, but in most blue states, you will see that is a requirement. And that is also predicated upon a percentage of the salaries that you pay. And that fluctuates based upon the nature of the job. So for those that are familiar with workman's comp, it essentially covers employees if they get hurt on the job. So if they're performing on the job, they get hurt, they're out for a while, the insurance will kick in and it'll help pay for medical expenses to recover. And then in some instances will supplement or provide a portion of income to the worker while they're out on disability or on leave while recovering from an injury. But it has to be work-related injury. So if you're at home or out and about, that doesn't count here. It's specifically while working. But those premiums are based upon a percentage of the individual's salary or wages. And it fluctuates based upon the nature of the job. The more inclined or the more likely that someone may get hurt on the job, the higher those rates are, and vice versa. So if you have employees that are working in the office or doing administrative stuff or an office setting, the likelihood of getting hurt on the job is very low. So as a result, the premiums are low, and vice versa. So if you are on a job that requires a lot of physical activity, then the likelihood is greater and those premiums are higher to reflect that. So I'm thinking things like caregivers, if you're in the health industry, construction, warehouse workers. So those are all things that require physical activity to do the job. The chances are higher that you'll get hurt. Now, the way the rates work, just so you have an idea, I was an employer of caregivers at one point, and I was paying about 5% of the wages. But again, that's on the high side because the nature of the activity was laborious. There's a good chance that you can get hurt. So that was on the high side, but admin was maybe about half percent to 1.5% of the wages. So again, quite low for there, but again, it does vary based upon the nature of the job. So that's another thing you have to account for in your budget when bringing employees on. The third point are benefits. With your benefits, you have to account for paying your employees right. If you're offering, not every employer offers benefits, but if you do, there is a cost with that. The biggest being health insurance and retirement plans. With health insurance, if you hear about jobs that say, oh man, I have really great health insurance, I don't pay much for it. You don't pay for it, that means your employer is paying for it. And it can vary. So what I've seen as far as that cost, the employer can decide how much that they want to pay for the premium. Usually the way it works, you go to a health insurance broker, get a group rate, which tends to be a bit cheaper depending upon the number of employees that you have under a plan. So you have one company, you have all your employees, including yourself, you can get a group plan. I think you have to have at least 5 people to be considered in a group. If you have less than 5 employees, you may be better off where the individual gets the insurance on their own, and then maybe you can work out some sort of reimbursement there. But nonetheless, with those premiums, as an employer, you can decide how much of that you want to pay. So I've seen it where employers will say, okay, I'll pay half of the premiums, and then the employee will be responsible for the other half. I've seen it where employers will cover the whole thing. As employers, you can have an idea or play with the numbers to know how much of a premium that you want to pay on behalf of your employees. So if you offer health insurance, that's one thing to account for. And then also the retirement plan. That's another big benefit that many employers offer. The most common plan is the 401k. So you'll have 2 components. Maintaining that 401k, usually 401k administrators will charge you by the employee. There is a dollar amount that you'll have to pay either on an annual basis or on a monthly basis for them to administer and maintain the plan. And obviously they're holding the funds. You have to account for that. I think I've seen it where on the cheap side, I might have seen $50, $75 per person per year. On the high side, I think I might have seen about $250 per person per year, but don't hold me to that. But nonetheless, there are plans out there that you'll have to account for and pay for. So that's on the administrator side. Then you also have to factor in employee matching. If you choose to do that, you may not choose to do employee matching, but it is a perk that we see a number of employers offer, where if you're matching a contribution for an employer, then obviously that's money that's coming out of your pocket. Not everyone is going to participate, but the way to budget for it is you assume you offer to them, then you budget as if everyone will participate in it, and you'll have to contribute the maximum amount. What I've seen a number of employers do is they'll say, okay, we'll do a 3% match up to the first $5,000 or something. So if the employee puts 5,000 in, then you'll put in 3% of the first 5,000 in, but you cap it. like limits your expenses as well. So that's another thing to account for when bringing employees on board. So there you have it, a number of hidden expenses or expenses that you may not think about when bringing employees on board. So make sure you factor those into your budgets when considering bringing on employees to help you on your journey. So that's all for now. I hope that helped. And if you have any more questions about this topic or any other accounting or tax related questions, feel free to reach out. Happy to help. That's all for now, and I'll talk to you next one.